Hello everybody and welcome back to day 3 of Surety Week. I'm Daniel De Burca, I'm the Head of Public Affairs at ICISA, so I'm very pleased to bring you what we're going to present to you for day 3. If you've been with us already, I hope you've enjoyed what you've seen so far. I think we've had some really interesting presentations and discussions. But if this is only your first time joining us, where were you? But still, welcome on board. I was pleased yesterday to be able to moderate a panel on sustainability and surety's role within that topic. And later in the day, we also had a session which took the views of ICISA surety members about future expectations in the market, as well as work on producing a suretypedia within ICISA's surety committee. So if you haven't seen those events, be sure to go back and register for them. You can still do that. And then you'll be able to view those sessions again. And if there are any sessions in the future that you'd like to attend or would like to watch back again, you can do so by registering for those events, and you'll be provided with a link to view them in the future. Later today, we have a panel which will look at lessons that can be applied in different jurisdictions from changes in bonding laws in Ontario, Canada recently, and in particular how this could be applied to the UK market. So that's a really interesting discussion, and I hope you can join us for that. But first, we have a really interesting session lined up. We have provocatively titled this Surety versus Guarantee, but this is really a chance for us to look at the differences as well as the similarities in the way banks and sureties provide these kind of similar products. As ever, if you have questions, please drop them into the chat. We'll be following that along as we go. But to get things started, I'm very pleased to hand over to the moderator for this panel, Jos Kroon, who's Managing Director for EMEA at Liberty Mutual Surety. Over to you, Jos.
Thank you, Daniel. Good morning, everybody. As everybody is coming into the meeting, I see the names passing by on my screen, and it's good to see that there are so many familiar names. I was thinking that given the time of day, there might be quite a few people. It might be too early for quite a few people, given the fact that we're 10 o'clock in Europe. It's still early in South America and the US, but I see some names passing by from those areas as well. So I'm quite surprised that you took the effort to get up early and join us. So you're very welcome. For those of you that I don't know, let me introduce myself. Jos Kroon, as Daniel said, I'm the Managing Director EMEA for Liberty Mutual Surety. I've been in this business for quite a while, and I can share with you now that by the end of next month, I will be ending my working life in surety as I'm retiring from Liberty Mutual. So I enjoyed this opportunity to share a panel for ICISA this morning, and especially because we have 3 panel members that I particularly appreciate are participating this morning. Let me start with the lady of the 3, Mirjam Wijtenberg. She is Head of Trade Finance Benelux at Deutsche Bank, but she will introduce herself in more detail to you. And she is joining us from Italy, where she is vacationing with her family this week. So we really appreciate that she took the time to join us. Welcome, Mirjam. Then there is Juan José Montes from Solunion, the joint venture between Mapfre and Euler Hermes in Spain. He is joining us from London, we understand, and he will provide us with the perspective of the sureties. And Mirjam, of course, will do that on behalf of the banks. And then we have Henk Redijk, who many of you will know. He has been around in surety for as long as I remember, even longer than that. And after a long history in surety, he joined several construction companies. He will tell you about that. So he is able to provide us with the client perspective in this discussion. That being said, I think I would like to give the panel members an opportunity to introduce themselves in a little bit more detail and provide sort of a summary of their perspective on the topic. So if I can start with you, Juan José, go ahead.
Thank you, Jos, and enjoy your new times that you are affording in the coming weeks. So good morning to everybody. Thank you for ICISA to give me the opportunity to be here with all the community. As a starting point, I think that we need to remark that when we talk about bonds, both banks and sureties do at the end the same thing. That is to try to help our clients to ensure transactions in favor of their own clients that are the beneficiaries of the bonds. So this is at the starting point. So we will try, or I will try to remark some differences from my point of view. And my point of view is, of course, conditioned because I am working in Solunion, as you just explained. Solunion is the joint venture of Allianz and Mapfre to develop surety and credit insurance in Spain and Latin America. Before that, I was the head of surety in Mapfre, that is one of the parts of this joint venture. So my experience is more focused in the Spanish market and in Latin American markets, because in Spain, Solunion is the direct insurer. So in Spain, we have direct contact with our clients and we issue the bonds. And in Latin America, we are reinsurers of the Mapfre operation. So in Latin American countries, Mapfre issue the bonds, is the company that has the relationship, the direct relationship with the clients, and Solunion is the captive reinsurer of Mapfre for these operations. So I think that this is important, this point of view, because from my perspective, Spain and Latin America are really different markets. Starting in Spain, I think that a very important characteristic of surety compared with bank guarantees is that our bonds are not registered in the central bank credit desks. So in this way, our clients can have their credit worthiness better and use the lending capacity to finance projects. So because in Spain, when you go to ask for a loan, all the banks review this report of central bank, and if your level on loans is too high, maybe it could be complicated to have more access to the credit. So I think that this is really important thing, this characteristic of surety in Spain. Of course, for big corporations, this is not so important because they have more access to credit, but I think that for SMEs, this is really critical. And the second point, from an underwriting perspective, I think that maybe banks are more focused on the financials of their clients, and sureties, of course, are concerned about financials too, but we put more the focus on the project itself and the experience of the client, and these kind of things that for SMEs are more important. Again, talking about Latin America, that is a continent with less developed financial system, especially for SMEs. I think it's important that these clients have a source to have the bonds different from the banks. And at last, I think that for sure that banks do properly their job issuing bonds, but surety companies is the only thing that we do. So we really focus and effort to improve our service to the clients and to be really 100% focus on provide bonds to our clients. So maybe this characteristic of big core business do that we are improving and trying to do new things like this e-signature or wherever for our clients. So I think this is the most important things to remark in the differences between bank guarantees and surety companies. Again, not forgetting that we do, at the end of the day, the same thing.
Okay, thank you, Juan Jose. Miriam, would you like to go ahead and introduce yourself and the topic?
Thank you, Jos, and thank you, Juan, for the introduction. And good morning. It may be good evening or a very early good morning to all of you. And thank you for participating today, and thank you for the invite to be joining you today in the Surety Week, which is a new and I'm sure a continuing event for the future. So my name is Mirjam Wijtenberg. I'm Deutsche Bank's Benelux Head of Trade Finance and Asset-Based Finance. I do that out of Amsterdam with my teams, and asset-based finance actually was quite new to Deutsche, and I've been building that product proposition for Deutsche Bank out of the Benelux, but with a global proposition. Before doing so, I've been now with trade finance in several roles. Before doing so, I've also led some strategic initiatives for asset and wealth management for Deutsche, as well as for corporate cash management. For example, I introduced the SEPA payment directive for all corporates of the GTB in the Benelux for Deutsche. And before joining Deutsche Bank, that has been 10 years ago, I held several coverage positions at a local Dutch bank. So one could say I've been educated in a broad way, both on the private side as well as on the corporate side from a banking perspective. Haven't been with surety, but of course have been working with surety providers, especially over the past 6 years, with a very good experience. And that is where we join in the middle, where we meet. From a bank perspective, we have a service aim, and that is servicing our clients in the best way possible with the best product solutions, but also with the best advice as to our ability, right? And from a bank perspective, that would be looking at a corporate, as I'm part of the corporate bank in Deutsche, looking at the corporate, looking at the rating, of course. So we have we make an assessment of the counterparty risk, like we call it. We look at the performance, but also at the outlook of the company. And when issuing a guarantee, of course, we also look at the underlying project or the underlying ask. But for us, the first thing we look at is the counterparty and how do we assess the risk. And that would be, I don't want to give away everything, how we look at it. So I would also leave some content behind for questions or during the discussion.
Okay, thank you, Mirjam.
Okay.
Henk, go ahead and introduce yourself.
Well, good morning, everybody who is looking at the moment, and maybe good evening. It's a great pleasure for me to participate in this panel. And also good morning to Mirjam and Juan Jose, and of course to Jos. I have been in the surety business for at about 32 years, and that's a long time. I started my career in 1976 at Nationale Borg, nowadays Liberty Mutual, in 1976. And from the beginning, I was involved in underwriting and commerce. And 12 years later, in 1988, I was one of the founders of Interborg. And after a successful development of the company, 12 years later, we sold the majority of our shares to Euler Hermes. And some years later, Euler Hermes took over all the shares of the company. In 2007, I left the company and started another career. I was involved in several construction companies as a manager. I was a member of the supervisory boards, and later on also I had some advisory functions in timber trading companies and also with semi-government institutes. At the moment I'm retired, but I'm still active as an advisor in some construction companies, and this morning I will also give the feelings from the Dutch market, from the users of guarantees or bonds. And I can tell you there are still some wishes which I want to raise, and maybe it can be a part of our discussion. Of course, and I already heard it from Juan Jose, the most attractive things from a surety company is that they offer facilities without asking hard collateral. But there are some wishes from clients here in the Netherlands, especially from things which happened in the last years, that clients are looking for long-term relationships. for better and for worse. We know things can happen in economics, and well, a lot of times people have a lot of difficulties to have a continuing facility with companies. And an important thing is also that clients wish that financial institutes, sureties or banks, does not only look at figures, but also at the development of actual business risk or zoom in more in depth on the businesses. In general, I must say that we hear in the Netherlands that banks only want to issue guarantees with a fixed expiry date. And that's not always a thing beneficiaries would like to see. That is a thing I want to raise. A very important thing is that some surety companies also have a possibility to issue credit insurance. And there you have the accumulation risk. And that plays a role in the moment, on the moment that businesses go not so good, go worse. That's the thing I also want to raise, that maybe the institutes, surety companies or banks can be more prudent with offering facilities, maybe a lower facility and a stability to continue that facility, as well, say on the moment we are going to decrease the maximum amount of a facility. That always comes on the wrong moment. Well, that are some things I want to bring in this morning. I have more things on the list, but that will come during the discussion, I think.
Okay, thank you, Henk. I think it's maybe important before we continue to point out something that Carlos or that Juan Jose has already raised, and that is that surety or issuing guarantees in general is a practice that is not the same in every country in the world. It differs by geography, and we very often run into that. We are now talking about banks versus sureties, but that almost assumes that we are talking about markets where banks and sureties are both active in markets. I think it's important to point out that the largest surety market in the world, the United States, is exclusively an insurance company market because of the legal constraints that exist there for banks to issue guarantees. And that creates an entirely different playing field, of course. And we can almost exclude that from our discussion today because it's obvious who is issuing the guarantees there. It's the surety companies. Another issue that comes into play is that in some markets, government entities are required to ask for a guarantee from the construction company if they are to spend any taxpayer money. From the European perspective, maybe except Italy, where there is the Morloni law, we feel that is a very enviable position because it creates a market and you don't have to fight for it. And then there is all these other markets that have systems in between. Maybe I should add that the United States also have 100% of the project value requirement. And in Europe, for instance, it's often a penalty bond that is at 5 or 10% of the project value. Canada has something in between, they're at 50%. Latin America has different practices. So it's very hard to focus this, to pinpoint this discussion on one particular market. So we have to take that into account all the time. There are, of course, big differences, and Juan Jose pointed that out between Spain and Latin America. Can you elaborate a little bit, Juan Jose, on not just the way underwriting is done, and that may have to do with the size of the clients in the various markets, but how does it work in South America? Is it exclusively sureties who issue bonds? And what kind of bonds are issued? Because that is the next issue that we have to address. Are they on-demand bonds? Are they conditional bonds like sureties traditionally issue? And maybe South America is a good place to start. How does it work in general over there?
Thank you, Josh. It's complicated because I have a colleague that says that Latin America is just a name because we have several countries, each one with different practices and different markets. So it's really complicated to put together Argentina or Panama that are really conditional markets with Ecuador that you need to issue on-demand bonds with really complicated situation with the beneficiaries. But trying to focus on the question, I think that in Latin America, if you talk about the traditional bonds or the traditional bonds from the point of view of the surety companies that are performance bond, bid bonds, and that base payment bond linked to a project, I think it's a surety market. So I think that the banks are not really interested or really focused in this market in most of the countries in Latin America. For instance, Mexico, that is probably the biggest market. If you exclude Brazil, with these judicial bonds that are really hard in the last times, you can see that almost all the companies try to provide fianzas, that surety bonds, and they are not asking for bank guarantees. But if you move to payment obligations, so then you can see that the risk appetite of the sureties in Latin America is really low. And even in some countries, the law doesn't allow to issue this kind of bonds. So the banks are much more prominent in this kind of bonds, and the surety companies are really focused in the traditional bonds or the bonds linked to the construction project. I think this is my point of view, and it's when I share with my colleagues or for insurance companies, I think that we have a similar approach.
Okay, so that's if I try to summarize what you're saying, Jose, then you say that for different products, there are different suppliers. Basically, the sureties provide the traditional guarantees for like construction companies. Payment obligations are covered by bank guarantees. That makes a nice division of the market, because then the two don't compete for the same business. In Europe, of course, that is different, because we have most markets. Again, maybe the biggest exception is Italy, where banks and sureties are obviously alternatives for one another, and they're like Henk said, the client perspective is very important. Like, why would one go to a bank? Why would a client go to a surety? The additional capacity that is provided by a surety, that is what you mentioned, Juan Jose. I think that will be something interesting to ask Miriam. We say we provide extra capacity as sureties for many companies, because the capacity that we provide comes on top of the lines that they have with banks. How do banks look at that? Because from my perspective, I would say there's only so much risk that should be taken on any one company, and if you pile one on top of the other, it has a consequence for all parties involved.
Yeah, thank you very much, Jos, for the question. Well, I think the biggest difference between the surety provider and the bank is also that normally the bank would have a broader bank wallet, right? So there would be a cash management wallet or an FX wallet, or maybe even a lending facility. And that has two sides, right? So it's one, you have a bigger risk because you have assessed the risk, you have risk appetite, and you have a bigger risk on your books. At the same time, you have a broader view on the type of risk, but also on the performance of the company. How is the company acting? Where are payment streams going? And that supports you also when taking a assessment on issuing a guarantee. So I'm not sure if it's really piling risk or it's next to each other, because that could also happen, right? That, for instance, when a bank would say, well, I have this bank wallet, I have appetite for a certain project, and I'm happy to issue a part of the guarantee, but maybe not the entire guarantee. And then one could also decide to share the risk. And that happens more and more often also with larger projects. When the project is smaller, it's more difficult. I think Henk also mentioned that for SMEs, it can be even more challenging because there is less public information available. So you really have to know the client behind the company. You have to have a certain years of relationship building. Whilst with a larger company, there's more public information, there's more information, but at the same time, the risks get larger, where one could consider to share the risk.
Okay. And if you look at it from the client perspective, Henk, you mentioned that there are several issues that are important to a client, the long-term relationship, and how they look at how they assess the risk. But when you have a project and you are participating in a tender and there is a requirement for a bond, do you consider the requirements of the principal, for instance, when you choose a provider? Because assuming that you have both surety capacity and bank capacity available, how do you make that choice?
Well, let's say we have also here in the Dutch market at this moment a little bit a problem for the branch awareness. A lot of beneficiaries don't know what is, for example, now I'm sorry to say Liberty Mutual or another name.
We're working on that.
A lot of things changed last years, and I know from my time in the past at Nationale Borg it cost a lot of time to convince a beneficiary that a bond of Nationale Borg was as good as a bond from a Dutch banker. And nowadays people are maybe here in a better position, especially in the construction market, that there is a lack of capacity to build. And now they can go into a negotiation with a beneficiary to say, well, I have here a bond from a certain surety company, and I can convince you that it is as good as a bond of a Dutch banker. And so that discussion you can have at the moment. But in other market circumstances, people, especially for the SMEs, they try to issue bond from a surety company because then they keep intact the facilities with the banker, of course, which is also important for the lending capacity.
Okay, but what do you think is it only the brand awareness that that beneficiaries consider when they say who do we accept as a guarantee provider, or does it also have to do with the perceived quality of the product, say the wording, the ability to pay, things like that?
Well, let's say I think you personally will remember in the Dutch market we had in the past a few beneficiaries who preferred a bond from a surety company because they said a surety company has a very severe underwriting procedure, and then we know for sure that the project will be finished. Because I'm not blaming banks, but in general banks looked at securities. Do we have a lot of securities? And then we will issue a bond or we will give a lending capacity. And a severe underwriting was an extra guarantee for some beneficiaries in the Dutch market. They said, well, now we are sure that the project will be finished, because if not, the surety company must pay, and they don't like to pay.
Mm-hmm. Okay, but do you recognize that, Juan Jose, that the underwriting process of the surety is more or less considered as a pre-qualification by the beneficiaries? That they say if you pass the screening of the surety company, then you must be a good contractor.
To be honest, as Sometimes you can see it in several markets, but unfortunately, I have more the opposite vision in some cases. I think that still some private beneficiaries, almost then private beneficiaries, prefer a bank guarantee. And I think that it's because sometimes it's a confusion between the company and the wording. I try to explain briefly. You know that for years, the surety companies have been reluctant to issue on-demand bonds. So the beneficiary maybe have the impression that the company is trying to refuse the payment in case of a claim, but it's not that. Is the wording say that you need to prove the breach of the contract? The company asks for the proof of the contract. But if the company issue a on-demand bond because the client asked it, we will pay on demand. So maybe this confusion between the instrument and the companies are damaging our image in front of some beneficiaries. Because at the end of the day, a big company like imagine Euro Hermes or wherever with a strong rating, of course, will be paid in the same time and with the same solvency that any bank on the world. So I think that maybe the confusion is coming from this practice to avoid some kind of wordings.
Okay. And Miriam, how is that with banks? Do you always issue on-demand guarantees, or do you also, at the request of a client, issue conditional guarantees where you first have to investigate the validity of a claim before you pay?
We would go for the on-demand guarantees. That is the usual practice that we would do. And I think what we already tipped about, what we mentioned earlier today, is that we could learn from the surety provider who takes a broader view on the project, right? The underlying project, and assess the various steps that need to be taken into, for example, a construction project, where the bank would, of course, need to understand what steps are taken, but we would not go as far as a surety provider, and depending on the corporate could choose between a bank or a surety provider, also dependent on what the corporate is looking for. And that is where we see that over the past years, the construction market has been challenging for that reason, for us to really assess also the recovery of a lot of construction companies. How are they performing nowadays, and to regain the trust. Whilst I'm sure as they are performing, the trust should be there. So that's also an aspect I think that is that's coming into play. Trust remains a very important topic, which has not been discussed today yet, and also rating, right? So and also the rating of, for example, Deutsche Bank has been part of the assessment of a corporate to ask for a guarantee from Deutsche Bank instead of a surety provider, and vice versa. And over the past years, we have our rating has improved to A- again, but it hasn't been that way. So I think also a couple of years ago, we lost. I'm not sure it's about losing and winning, but a lot of corporates turn to other banks or to surety providers to ask for a guarantee.
Mm-hmm. Okay, you mentioned a few aspects that I would like to come back to in a little bit, but when you talk about say underwriting and the assessment of risk and how to no, let me postpone that. One other aspect I want to mention. We were talking about the wording, the on-demand, things like that. Do you, and that may be a question to both Juan Jose and to Miriam, how do you advise clients on the wording of bonds? Do you look at the wording that a client presents to you and do you analyze it and say, okay, there is a risk in this, we advise you to change it or go back to your beneficiary? How do you do that, Miriam? Does that happen at all, or do you rely on the client's ability to assess that's the wording?
Luckily, they turn to us for advice on the wording as well. So, of course, when it's a reissuance of a guarantee that has been used more often, then I think we're we can be quick and we can be fast, but especially for new projects or one-off guarantees, we tend to take a very close look and advise the client, and it depends, right? So it depends on the size of the company as well, whether or not we can change wording for the clients, to be beneficial for the clients. But it's not always possible. When we deal with a treasury center of a global corporate out of Asia, for example, it can be a bit more difficult. But we would always look at, especially at the country risk or at the European risk. We have the expertise, and we would definitely advise the client if we think the wording can be better in favor of the client. We would definitely advise to do so.
Okay. Well, Jose, I assume you're going to say you do the same thing.
Yeah, absolutely. And I think it's really critical when you are talking about projects abroad, because if a Spanish company go to do a contract in Colombia, we always try to remark all the differences and all the obligation they are assuming, because sometimes you are expecting that the things works in the same way than in your market, and this not in this way. So yes, definitely we advise our clients, and we decide together if we use wording or not. Sometimes, as Miriam explained, you don't have more alternatives that choose or not or refuse it, but sometimes we can deal together with the beneficiary a different wording. I think it's a service that is really appreciative for our clients.
Okay. Now, then let me ask the same question to Henk. And I think I may be a little bit biased here, which I should not be as the moderator, but I would think that if you are to issue a not an on-demand bond, but a conditional bond, that can often be to the advantage of the client because it gives him more defense, ways to defend himself. But how do you look at that, Henk? And what is your experience with the two banks and sureties in terms of wording advice?
Well, it's nice to hear what Juan Jose told about his experience. In the very, very past, I'm sorry to say, when I was with National Board, well, we only issued conditional bonds. Unconditional bonds, that was, well, it didn't happen often because we refused it. But due to competition with the bankers, we were more or less forced to issue unconditional bonds. And well, that is quite common nowadays here in the Netherlands also. So also the surety companies provide unconditional bonds also. There is another thing. There are also sometimes in the market useful things. Here in the Netherlands we have some branch institutes who agreed with governmental parties upon bond wordings. And especially in road construction, you see that conditional bonds are accepted, for example, by some ministries. And that is a very good thing, I think. And that's also a thing what happens here.
Mm-hmm. Okay, good. If I go back to things that were mentioned earlier, we were talking about continuity of relationships and the financial assessment, and of course the prospects of a company. Well, of course, I can see that from the client perspective, Henk, you prefer to have a long-term relationship for better and for worse. To what extent is that possible? Because there is, of course, this opposing interest that a bank and a surety may have at some point. But how does that work in your underwriting, Miriam? What are your main criteria in the underwriting, and how can you accommodate companies who are looking for a long-term relationship?
Well, if a corporate would turn to us so let's say a new corporate would turn to us just with a question on to issue a guarantee, that would be more difficult compared to a situation where you would already have established a relationship, more, and preferably, for example, in cash management or in lending, whilst that differs per region and that differs per continent. But for Europe, and especially for the Netherlands, a lending relationship is often the basis of a banking relationship, followed by cash management, and then other products like product solutions like FX or trade are added to that. So entering a relationship with just a bank guarantee would not be in favor for us, and especially also because we are from the corporate side of the bank, right? So in the private bank, a rental guarantee that's something out of scope, let's say for this discussion. So looking at the relationship and looking at the corporate, that would be preferable because we aim to build long-term relationships. And it was also mentioned in the introduction that sustainability comes into play here as well. And sustainable revenues is for us as a bank very important, but also we want to build a sustainable relationship and that the corporate can be sustainable in its future outlook, be it their performance, be it the products that they produce or the products that they sell. So I think it's a broader perspective nowadays, and that I think the same is for a surety provider, right? Because a surety provider, I would say, also wants a long-term relationship with a corporate. Also, even when the product solution is not as broad as the bank can offer.
Mm-hmm. And you as a banker, of course, have insights into a corporate that sureties do not have. Such as the movements in accounts and things like that. Does that allow you to continue a relationship? Say we're looking at a company that is not doing so well, and really needs the capacity that you provide in order to continue its business. Then would you say that as a bank you are able to continue longer than a surety because you have more insight, or you have maybe more collateral, or and as a company is doing poorly, would you change your relationship in terms of the conditions that you impose?
Well, normally, I think we all have learned from the past in terms of when a corporate goes into a lesser performance or even into a default state. It's often not in the interest nor for the corporate nor for the bank to issue or to ask for a lot of cash collateral or for additional conditions where the corporate runs into a greater trouble, right? So there is a fine and a thin balance between protecting, of course, the risk and the collateral of the bank, but at the same time ensuring the continuity of the corporate. And for me, especially when you have, it doesn't matter whether or not the relationship is long or short. You need your partners, your partners in crime, so to speak. So you need your partners in business. So you have to take your role and your responsibility. And when you have assessed risk at a certain moment, and that risk is deteriorating, you need to rethink and to assess and reassess and look for the best solution for both parties. Because when just looking from a bank perspective, I don't think you will end up in the best situation. You need to look at it from both perspectives. And that can be that you need to ask for certain cash collateral or maybe a higher pricing, right? But only when necessary, and not continue that situation too long. And it should always be the aim to have the corporate in a good performance again. That should be the ultimate aim, or and the corporate to finish the project that it was working on, or to deliver upon the deliveries that the corporate has committed to.
Okay. Jose, how do you think sureties act differently maybe from banks in trying to provide that continuity and continue relationships?
If you talk about a normal situation, of course, everybody look for a long-term relationship. for surety companies is critical because we only have this source of incomes. You only issue bonds, and not all the companies in the world need bonds. So we need to be really careful to keep our clients, our big clients that are like construction companies, for instance, that need a lot of bonds. So from this point of view, of course, we need to be careful, and the long-term relationship is really important for us. I have clients that I know from the beginning of my career in surety, that it was a long time ago. But to be absolutely honest, when things start to be worse, from my perspective, maybe the banks are more important than the surety companies, because sometimes when the situation is critical, even the survival of the company depends on the new loans or the renegotiation of debts with the banks. So maybe sureties can do something, providing new bonds or supporting our client until the last moment. But at the end of the day, I think that sometimes the companies are on hands of the banks, so they are more important in order to resolve these crises that sometimes happens. So we try to support the clients, but definitely I think that the banks are more important to help the companies to survive in the bad times.
Okay. So, and it almost sounds as if you're saying that as many things in life, it's good to sort of work together and talk to each other and try to find a solution that works well for everyone. There's one thing we haven't mentioned at all, and that is rating. Would you say, and let me go back to the client first, is there a difference you would think, Henk, in the rating that is applied by sureties and banks systematically?
No, I don't think so. Rating, you're talking about S&P ratings, for example.
No. I'm talking about, say, the pricing. Sorry.
Oh, the prices. Okay.
Yeah.
Well, let's say at the moment here there is a big competition in the Netherlands upon pricing, which is not good, I think, because of course a user likes it when the rates are going down. But I think if you want to strive for a longer relationship, stable pricing is very important. And yeah, of course, you have people who take advantage of lower prices, but at the end, things will be corrected when something happened in a branch and the risk will be higher, the risk profiles will be higher, prices will go up. So I say, and the same applies also about the topic we discussed just a minute ago, maybe one should look, and that applies for both banks and surety companies, for a normal facility and not a too high facility. Maybe a normal facility which can be continued also in worse circumstances with a reasonable price. That is a thing you should strive for also as a client, and not take the advantage from a certain moment that, well, you can buy a bond for a low price. What does it deliver at the end if you know that in a few years later you have to pay maybe double for a bond?
You are mute, Jos.
Yes.
That's I'm sorry. No, I was telling Henk he sounds like a very reasonable client. We see differently. No, but
I think it's different. It's challenging sometimes, right? So what Henk is saying, I recognize that a lot, not only from the Dutch market, but for example, also in the Belgian market, the competition is really strong. And it's really challenging when you look at the rating of a company, so the credit rating, and at the same time, sometimes the prices that are asked, but also that are already offered by other parties. It can be other banks, it can be a surety provider. We just can't compete with that. The difference in pricing is too high, and then we will be ending up in a, let's say, in a non-profitable situation where we can't join, and that's a pity, because we do have appetite. We do have we do want to be in the guarantee, or we want to take our part, but we just cannot do that when it's, for example, for a sub-investment grade company and they want a 20 bips on a guarantee issuance. We can't. And sometimes we do, but it's in the Dutch and in the Belgian market, that's very challenging. And then the surety providers often can come into play there.
Mm-hmm. Okay. Juan Jose, do you see differences in rating systems, or say systematic pricing differences between banks and surety companies, or?
I see difference, especially in big corporations. My feeling, I don't know, maybe I'm wrong, but my feeling is that sometimes the bank look to the package, and maybe the bonds is like a commodity, just to say, and sometimes they offer really low prices, so at least from my point of view. With the exception of this big corporation, I think that the market is aligned, that we have a space for offer our product for all the clients. And of course, it's different in the markets. You compare the prices of Colombia with the prices of Peru or Mexico are really different. But again, I think that with the exception of big corporations, maybe we can compete with in more or less loyal market.
Mm-hmm. Okay. Well, I'm keeping my eye on the clock. There, so far we have been talking about differences between sureties and banks. There must also be areas where they can work together. Juan Jose, if you answer that first, where do you see those areas?
I think that there's the most important is this master participation agreement, or the name that you maybe is a different name in the market, that is share risk with the bank. The bank issue the bond because the beneficiary asks for a bank guarantee, or because they have the relationship with the client, and we take a part of this risk. I think that is the most advanced way to collaborate. And of course, this is the traditional instrument to use a bank as fronting partner to issue bonds in behalf of you. And sometimes we see the opposite in really surety markets. Sometimes we issue bonds on behalf of a bank that acts to do it. So definitely, I think that we have a space to collaborate. And in my opinion, is increasing in the last years, and we are really hopefully to develop this way to collaborate in the future.
Okay. Do you see that similarly, Miriam?
Absolutely. So the master risk participation agreements are something that we have been working on for many years, and that is open to banks and to surety providers, of course. So that is something that we really like, especially on the larger issuances and the larger amounts. And then, I mean, it's also about together assessing the risk, and the way that works in, let's say, internally for a surety company with the underwriting of the risk with other surety providers, right? So, and the same in a master risk participation agreement, it's similar, where you together take the risk, and that's something that we welcome very much. And it can be open, and it can be disclosed and it can be undisclosed, but both are fine. And the fronting is, of course, something that we can do due to the at least for Deutsche Bank, due to the large network that we have globally, and there we can perfectly work together. And I welcome that a lot.
So what you're both saying is that, for instance, in the fronting, it works two ways. Sometimes the bank can front for the surety company because of the network that they have and the local presence in different markets, or the rating that they have, but also sureties can front for banks in markets that are real surety markets. That's what you said, Juan Jose, right?
Yes, it's not. It's more common that the bank front for a surety company, but we have cases when a bank acts, Solunion, Mafre, to issue bonds in behalf of them.
Okay. And the agreements that you say where sureties participate on say total exposure of banks, would those be for one-time projects or for facilities that can be used continuously? How would most of that work, Miriam, in your experience?
Well, normally where we started, it would be on a certain project or a certain issuance. But of course, there are also collaborations where we would do that from a portfolio point of view. So where the bank would have such an agreement with a surety provider and have an overall agreement, and depending on what business pops up, we would assess each and individual issuance to see if we could partner up there. Absolutely, yeah.
Okay, good. As I said, with an eye on the clock, I think maybe we should see if there's any questions that we should answer. But before we do, is there anything that either of you had wanted to bring up in this panel that I haven't asked about or that hasn't been covered? Because I'd hate to see you drop off the screen later on and think like, oh, I would have liked to mention something that I haven't had the chance to do. Henk, is there anything?
Well, yeah, there is one thing. As I said already, I'm also speaking for clients of sureties and banks in the Netherlands. And what I hear a lot of times is that it's difficult to get a bond with a longer duration. And especially that plays a role with the bigger projects. And you have to think on the big infrastructural works, for example. And well, surety companies always have a difficulty with a longer duration of the risk, and I can understand, of course. Banks a little bit less, I heard, but you see that the duration is getting longer and longer, also due to the fact that the projects are very big, but also for a kind of maintenance insurance. And maybe there is a possibility to work together maybe with a casualty insurer to create a new product for that kind of risks, because you come to a certain moment that you say, I can't oversee the period and I don't know if we can issue for such a long time, such a long duration, a bond or a guarantee. Maybe there is a chance to make a new product.
Well, there is quite an audience that you're addressing today, so people can take that back to their office with them as homework. But yeah. Is there anything that you would want to comment on that request right now, Miriam, Juan Jose, the duration issue?
I think it's well known, and it's it's a challenge for us to assess a risk longer than 5 years, right? So we rather do a reassessment after 3 years and then extend and extend. And of course, I understand the question from Henk. I will take it along with me. It's always good food for thought and good for a discussion with our product management team.
Okay, Jose.
Yeah, I think that is a big challenge for all the industry. And of course, if you can step out of the risk after some period, it's more or less resolved in countries like Colombia or Brazil. But definitely, if you need to be in the risk for 20 or 25 years, it's complicated. And I think that we don't have a real solution right now. It's something that I think that we should think about it more, because Henk is right. I think there's more and more governments are asking for long-term projects. So it's something we will try to resolve.
Okay, good. Now back to my question. Miriam, do you have any topics that you would still want to bring up that haven't been discussed?
Well, there's one topic which we didn't touch upon, and it's the time is too short, but I do think it's worthwhile mentioning, and that is part of the issuance of the guarantees. There's also increasing regulatory supervisory, which of course for surety providers as well as for banks have come into play, especially over the past 5 years. So transaction monitoring, anti-money laundering risk, and everything that comes into play to that, I think has made the issuances more complicated from an administrative point of view, and we need to document that in a very prudent manner. But it's also about protection, right? It's protection not only yourself as the issuing party, but also about protecting your client, so to speak, the corporate. And that was my link also to sustainability in the market and sustainable revenues. So that's something that I wanted to mention.
Okay, I'm sure that can fill another entire panel, because, well, I'm just thinking about a few colleagues I have in Liberty Mutual who would love to participate in such a panel, I think, and discuss those issues.
Very good.
Juan Jose, anything last to bring up?
No, I don't think so. Maybe to remark that in the last years, I've seen a really big effort of the companies, the surety companies, to modernize and to try to open their minds to new products and all these on-demand bonds, and try to offer a more comprehensive offer to our clients. So this is the only point that I would like to remark.
Okay, thank you. Now, let me ask Daniel if he has kept an eye on the questions that came in, and I'm afraid we're running out of time, but is there anything that we absolutely need to address right now?
Well, I think thanks to your expert moderation, I think you covered off most of the topics, and I hope the people who've asked questions have seen that in the conversation. There were some interesting conversation as well throughout it about differences in the US markets, in European markets, and different practices as well. So some really useful conversations and answers from different people there as well. There was one quite interesting question, which maybe we have a moment for, which was we talked about how rate changes, if there's a correlation between that and loss ratio, or does proper underwriting offset the negative effect in surety? That might be an interesting one for a brief comment.
Well, Juan Jose would be the one to comment to that. It's about, say, the rating and loss ratios, you said.
Yes. So with the pressure on pricing, does it affect the loss ratio? And does proper underwriting offset the risk there?
You know that there are a lot of analysis about it, and the PASA, for instance, remember some jobs about it. Honestly, I think that the loss ratio in the surety market is still really low, and sometimes the experience is not enough to have a real actuarial approach to that. Of course, we try to do it, and we try to put together the behavior of the market, the sector, the rating of the policyholders. But at the end of the day, I think that we don't have still the level of sophistication that we have in DCI, for instance. So definitely, I think that we have things to do in this way. For us, it's not the more crucial thing when we do the technical notes for the regulator and so on.
Okay, good. Then I think we should wrap up, because we're running, well, we're past our deadline. So I would like to wrap up and well, conclude that we haven't said the last word about these issues at all. There were a few issues raised that justify another panel on another occasion for the next Surety Week, I think. Meantime, I would like to thank everybody for joining us today, and especially I would like to thank the panel members, Miriam, Henk, Juan Jose. Thank you very much, and I hope you will enjoy the rest of the Surety Week. Thank you very much.
Thanks, Jos.
Thank you. Bye.
Thank you.
Thank you. Bye-bye.
Bye.
We look forward to seeing you all at 3 p.m. CET later today. Bye.